Gas hit $4 a gallon on Tuesday, and the White House said it barely matters because America doesn't import oil through the Strait of Hormuz. That claim is technically true. It is also profoundly misleading. The real story is not gasoline. It is everything gasoline is made alongside. Roughly a fifth of the world's oil supply transits the strait every day, and with it flows the feedstock for diesel, jet fuel, fertilizer, and polyethylene, the plastic in milk jugs, detergent bottles, and food packaging. Diesel prices have climbed $1.70 per gallon, about 70% more than the increase in gasoline. Polyethylene is up 30% since the war began, because 84% of Middle East output depends on Hormuz waterborne exports. Fertilizer costs are surging as natural gas feedstocks, also routed through the strait, become scarce. Nobel laureate Paul Krugman put the arithmetic plainly. Gasoline is less than half of what households consume from petroleum. Add diesel, plastics, and fertilizer, and the real inflation shock is at least double what the pump price suggests. Moody's framed it as a tax. In the months since the war began, Americans paid an estimated $8.4 billion extra on gasoline alone, before counting the pass-through costs in shipping, food production, and manufacturing. The burden lands hardest on lower-income households, who spend larger shares of income on transportation and food. The top 10% of earners account for nearly half of all consumer spending. If this war prolongs the squeeze, it is that bottom 60% whose pullback will show up first in retail sales and in GDP.
While the Hormuz shock is repricing essentials across the economy, one company entered April with a problem that predates the war entirely. Tesla delivered 358,023 vehicles in Q1, down more than 14% from the prior quarter and roughly 8,000 units below Wall Street's consensus. The miss would be unremarkable if competitors were struggling too. They are not. BYD delivered 300,022 vehicles in March alone, nearly equal to Tesla's entire quarter. NIO's quarterly deliveries nearly doubled year over year. Li Auto and Xiaomi posted strong month-on-month gains in the world's largest EV market. The divergence is the signal. Tesla's production delivery gap was over 50,000 units, meaning cars were built but not sold. That is a demand problem, not a logistics problem. Wedbush's Dan Oss kept his $600 price target and argued the bull case now rests on AI and robotaxis, not vehicle sales. That reframing matters. Investors who bought Tesla as an EV company are holding a different asset than investors who bought it as an AI-adjacent platform. The stock is down roughly 20% from its year-to-date high, and the consensus mean price target implies only 13% upside from current levels, an unusually narrow premium for a stock that trades on optionality. The question is whether the AI narrative can carry the valuation alone, without delivery volume as a floor. The two chains, a war-driven inflation shock and a demand-driven EV slowdown, converge on the same pressure point, the consumer. Jerome Powell this week called the national debt trajectory unsustainable, warning that interest payments already exceed defense spending on a quarterly basis. Trump's proposed military budget would add an estimated $6.9 trillion to the debt over 10 years. Powell is not raising rates into this. The Fed sees risks to both inflation and employment as balanced. That balance is the fragile assumption holding markets together. The weight of evidence points toward a stagflationary grind, elevated input costs, compressed consumer spending in the lower half of the income distribution, and a fiscal path that limits the Fed's room to ease if growth disappoints. That view holds only if the Hormuz disruption persists beyond a few weeks. If a diplomatic channel opens and oil retreats below $90, the fertilizer and petrochemical chains reverse quickly, and the inflation shock becomes a one-quarter anomaly. The benchmark to watch, Brent spot price in the next 5 trading sessions, and Friday's March jobs report. If wage growth is running above 4% alongside these input costs, the stagflation case strengthens materially. If payrolls disappoint, the recession scenario becomes the dominant risk instead. The leaning towards stagflation could be wrong, and the thing that would prove it wrong is a ceasefire announcement before the end of April.